Welcome back to the deep dive. Today we are unpacking a story that feels, well, it feels like a high-stakes sequel to a movie you've probably already seen.
Yeah, the classic Warren Buffett story.
Exactly. You know the original. Buffett builds a textile mill into the biggest conglomerate in history. But this sequel stars a completely different character, hedge fund manager Bill Ackman. And the plot. It's, a little more aggressive.
Aggressive is a very polite way to put it, I think. We are looking at a fundamental restructuring of how a major investor actually plays the game.
Right, because the question on the table today is, can you actually replicate Warren Buffett's success in the modern era? And I don't mean just, picking good stocks. I mean,
Yeah.
can you actually build the machine, the literal structure that made Berkshire Hathaway possible?
It's the holy grail of investing. Everyone wants to be the next Berkshire, but usually when people say that, they just mean, I want to be rich and old. Ackman is doing something genuinely different. He is re-engineering his firm, Pershing Square, to mimic the mechanics of Buffett's empire. But, and here is a twist, he's fueling this new machine with a portfolio that is 55% concentrated in just 4 massive AI stocks.
That is a wild combination. It's kind of like building a Victorian fortress, but then filling the armory with laser weapons. So our mission today is to break this all down for you. We've got a stack of recent portfolio disclosures, some really dense Wall Street analyst reports from early 2026, and the strategic documents regarding Howard Hughes Holdings.
And we need to connect those dots, because on one side you have this very boring insurance structure, and on the other you have a massive high-tech bet on the future of artificial intelligence.
Yeah. Before we get into the gears and pulleys of the strategy, let's just set the scene for a second. Ackman is a celebrity investor, sure. He's famous for his activist battles. But how has he actually been performing lately? Because, you don't get to pivot your whole business if you're losing money.
No, you definitely don't. And the short answer is he has been crushing it. We have to establish that he isn't coming into this cold. His hedge fund, Pershing Square Capital Management, has an incredibly encouraging track record. Over the last decade, he hasn't just matched the market. He's beaten the S&P 500 by 40 percentage points.
Wait, hold on. Let's pause right there. The last decade has been a massive bull market. The S&P 500 has been on an absolute tear. You're saying he beat that by 40 points.
That is the margin of outperformance, yeah. It's a highly serious number. In the world of active management, where most fund managers actually struggle to even keep up with the index.
Yeah, most of them lose to it.
Exactly. Beating it by that wide a margin buys you a lot of political capital with your investors.
Okay, so he has the chips on the table, he's got the credibility, but instead of just taking his fees and going home, he's deciding to change the game. He wants to stop being just a hedge fund manager.
Right. He wants to become a permanent capital vehicle. And to really understand why, you have to look at the central flaw of the standard hedge fund model. In a normal fund, if the market crashes, investors get scared and they ask for their money back.
Which forces the manager to sell.
You're a forced seller at the exact worst possible time. But if you are Berkshire Hathaway, nobody can ask for their money back.
Because it's a public company.
Exactly. You have permanent capital you can hold through the storm. That is what Ackman is trying to build.
So let's unpack this modern-day Berkshire ambition. How do you actually build that fortress? Because you can't just wave a wand and declare yourself permanent.
No, you need a specific mechanism. And for Ackman, that mechanism is a company called Howard Hughes Holdings.
Howard Hughes Holdings. Okay. Sounds like a real estate developer.
It is, or, well, it was. But the thing that really signals the shift happened back in December when Howard Hughes announced plans to acquire a company called Vantage Group.
And Vantages.
They are in the specialty insurance and reinsurance business.
Okay, stop. I need you to explain this to me like I'm 5 years old.
Sure.
Why does a stock picker who wants to buy AI companies care about owning an insurance company? It feels totally unrelated.
It does seem random at first glance, but this is the actual secret sauce of the Buffett model. It comes down to a concept called float.
Float.
Think about it this way. When you pay your car insurance premium, you pay that cash up front today. But you might not get in a crash for a year or 5 years.
Or hopefully never.
Right, hopefully never.
Right.
So in the meantime, who holds that money? The insurance company holds it. It's not technically their profit yet because they might have to pay it out later, but they get to keep it for now. And crucially, they get to invest it.
Oh, I see. It's like a free loan.
It's actually better than a free loan. It's a loan you don't pay interest on. And in many cases, if you run the insurance company well, the policyholders are effectively paying you to hold their money. Buffett used this free money, this float from insurers like Geico, to fund Berkshire's massive investments in things like Coca-Cola and Apple.
I get it now. So Ackman buys Vantage. Vantage collects premiums. Ackman takes that giant pool of cash, the float, and uses it to buy the stocks he really loves.
Precisely. It gives him a permanent capital base. He stops worrying about quarterly redemptions from nervous clients. He can now think in decades instead of quarters.
Which brings us to the stakes here. He's setting up this long-term structure. But unlike Buffett, who historically bought, textile mills, candy companies, and furniture stores.
The old economy stuff.
Yeah, the old economy. Ackman is taking this permanent capital and blasting it straight into high-tech.
That's the fascinating contradiction of this whole thing. It's the old school Berkshire structure, but the portfolio is pure Silicon Valley.
Let's look at that portfolio.
Yeah.
We mentioned earlier that he has 55% of his assets in just 4 stocks. That is a level of concentration that would give a normal financial advisor a heart attack.
It is extreme. It's what the industry calls high conviction.
So who are the big 4?
It's a roster of tech giants. You have Uber Technologies, Amazon, Alphabet, which obviously owns Google, and Meta Platforms, which owns Facebook.
And when you break down the weighting, it's even more stark. Uber is 16% of the portfolio, Amazon is 14%, Alphabet is another 14%, and Meta Platforms is 11%.
The connecting thread here is obviously artificial intelligence. But notice something specific about this group. He isn't betting on speculative startups.
Right. There's no tiny AI lab in there.
No, he isn't trying to pick the one tiny company that might invent the next chip. He is betting on the incumbents, the companies that already have massive global scale.
Now, we are going to focus today specifically on Uber and Amazon.
Good choice.
And the reason is, while Alphabet and Meta are huge AI plays, mostly on advertising and search side, Uber and Amazon represent something a bit different. They feel like the infrastructure of the physical and digital world.
I completely agree. They represent the utility phase of AI. Plus, they are the two holding the highest potential upside, according to the Wall Street consensus reports we are looking at.
Let's hit those numbers quickly before we dive deep. Based on prices in February 2026, analysts are seeing some serious room to run.
They really are. For Uber, analysts see a median 46% upside. That's a target of $105 a share against a current price of $73.
Wow.
That is a massive move for a large cap company.
Absolutely huge. What about the others?
Amazon has a projected 36% upside. Their target is $285 versus the current $209. Meta has 31%, targeting $850. And Alphabet has 23%, targeting $385.
So even the loser of the group, Alphabet, is projected to go up 23%. That's a career-making year for most investors. But let's zoom in on the one with the biggest target on its back, Uber.
The Robotaxi play.
Okay, I have to play the skeptic here. Because when I think of Uber, I don't think cutting-edge AI utility. I think of ordering a burrito at 10 p.m. or getting a ride to the airport in a Toyota Camry that smells like pine tree air freshener.
Right, that's the consumer experience.
Exactly. Is Ackman really betting 16% of his multi-billion-dollar fund on food delivery and taxi rides?
No, he isn't. And this is where you have to look past the app on your phone. Ackman's thesis is that Uber is the inevitable partner for autonomous vehicle commercialization.
Inevitable. That is a very strong word.
It is. But think about the empty car problem.
The empty car problem.
Yes. There are lots of companies building self-driving cars right now. You have Waymo, Tesla, Zoox. But if you are a company developing self-driving cars, you have a massive structural problem. You have the tech, but you don't have the customers. You don't have the demand liquidity.
You mean if Waymo drops 500 cars in a city, they just sit there parked unless people specifically open the Waymo app?
Exactly. And nobody wants to have 50 different apps on their phone for 50 different car brands.
Oh.
Uber has 150 million people opening their app every single month. They have the demand.
So Ackman sees Uber not as a taxi company, but as the Android of transportation, the operating system that everyone else just plugs into.
That's the exact bet. And the numbers back it up. Uber has a stated goal to deploy 100,000 robotaxis on its network by 2027, and their ambition is to be the largest facilitator of autonomous vehicle trips globally by 2029.
100,000 by 2027. That is really soon.
It's right around the corner.
But are they actually doing it, or is this just a slick PowerPoint slide for investors?
Oh, it's happening. Look at the partnership network. They aren't trying to build the cars themselves anymore.
Which is smart, because building cars is incredibly expensive and hard.
very hard. Instead, they are partnering. In the U.S., they are working with Waymo Alphabet's division in Phoenix, Austin, and Atlanta. They're working with Avride in Dallas.
And it's not just the U.S. either.
No, they have WeRide in the Middle East, places like Abu Dhabi, Dubai, Riyadh. They are expanding to 12 more cities by 2030, plus near future launches in LA, San Francisco, and London.
And there's an infrastructure angle too, right, with Nvidia?
Yes, crucial point. Uber works directly with Nvidia for hardware, software, and sensors. It's a deeply integrated tech stack.
Okay, so the cars are hitting the road. But there was a detail in the report about Uber selling services to these fleets. Telemetry, field support. What does that actually mean in plain English?
This is the hidden revenue stream that people miss. Imagine a fleet of robotaxis. They don't just drive themselves perfectly forever. They get dirty, they get confused by construction, they get stuck.
Someone spills coffee in the back seat.
Exactly. Who cleans it? Who goes and retrieves the car when its sensor fails in an intersection? Uber is positioning itself to handle that messy, physical operational layer. They offer fleet management, remote assistance, and even insurance to the fleet owners.
Let me get this straight. So they get a cut of the ride because they found the passenger.
Yeah.
And they get paid by the fleet owner to manage the car.
It's a double dip, and it makes the ecosystem incredibly sticky. Once a fleet operator integrates with Uber's operations center, it is very hard to leave and go somewhere else.
I can definitely see why Ackman likes the economics.
Yeah.
It's asset light. He loves businesses that don't need to buy expensive machinery. But let's talk about the price. Is the stock expensive?
Ackman actually thinks it's cheap. He is more bullish than Wall Street. The consensus is that earnings will grow about 25% annually. Ackman sees 30+% growth, and right now, the stock is trading at roughly 15 times earnings.
Okay, for the listener who doesn't spend their day staring at a Bloomberg terminal, 15 times earnings, is that good? Bad?
For a tech company growing at 25 or 30%, it's arguably a steal. Usually, you pay a much higher premium for that kind of growth rate. Ackman looks at that and says, this is mispriced.
All right, so that's the Uber thesis, the operating system for autonomous transport. Now let's pivot to the other heavyweight in the room, Amazon. It's 14% of his portfolio.
The absolute beast.
We all know Amazon. But Ackman isn't buying it just because he likes free prime shipping. He is looking at it as a two-pronged AI play. Retail and cloud.
Correct. And AI is turbocharging both sides of that house right now.
Let's start with retail. We've been hearing about Amazon warehouse robots for a decade. What is actually different now?
The brains. Before, the robots were programmed to do very specific repetitive tasks. Move box A to slot B. Now, Amazon is the largest operator of industrial mobile robots in the world, but they are deploying new AI models that allow for advanced robot navigation and, crucially, natural language commands.
Wait, so you can just talk to the warehouse system?
The system understands context now. It optimizes demand forecasting, inventory placement, and those complex last-mile delivery routes in real time. Every tiny percentage point of efficiency they squeeze out of that massive retail network translates to billions in bottom-line profit.
That makes sense. But the real profit engine, the thing that actually keeps the lights on at Amazon, is AWS, Amazon Web Services.
Absolutely. The cloud, they are dominating the space with a 41% market share. But there is a specific concept here that CDO Andy Jassy talks about. He calls it data gravity.
Data gravity. I love that term. It sounds like something out of a sci-fi movie. What does it actually mean for a business?
It's actually simple physics applied to server farms. Imagine your company has 10 years worth of customer data stored on Amazon's cloud. Petabytes of stuff. Massive files. Now, you decide you want to train an AI on all that data.
Okay.
You have two choices. You can try to pipe all that massive data over to a competitor's cloud, which is slow, incredibly expensive, and a massive security nightmare. Or you just bring the AI to where the data is already sitting.
I see. The data is so heavy it pulls the applications to it.
Exactly. That is gravity.
Right.
Because everyone has been storing their data on AWS for the last decade.
Right.
They are naturally going to build their AI tools there too. It's a moat that is very hard for competitors to cross.
And Amazon isn't just relying on gravity. They're providing the picks and shovels too. Right?
Yes. They are building their own custom chips, which is already a $10 billion business for them. And they are the primary cloud provider for Anthropic, which is one of the major players in the AI space.
So they have the customers locked in. But Amazon is also spending an absolute fortune to build this out. I've seen the reports. The capital expenditure is eye-watering.
It is. They are buying chips, building new data centers everywhere, and that is the bear case, or the risk. Some investors worry they are burning way too much cash on this AI arms race.
So what's the counterargument? Why isn't Ackman worried about all that spending?
Because the financials show it's already working. In the fourth quarter, their operating margin was up 1.5%, but the big number is AWS revenue. It was up 24%.
Wow.
That is the fastest growth they've seen since 2022. It suggests that the reacceleration is real. They are spending money to make money, and the money is starting to flow.
And what about the valuation for Amazon? Is it priced for perfection like Nvidia?
It's trading at 29 times earnings. Now that is higher than Uber's 15 times. But for a company of Amazon's quality, arguably one of the highest quality businesses in history, 29 times earnings is not historically expensive. Earnings are expected to grow at 17% annually. Ackman sees that as a very fair price for a dominant monopoly.
So let's zoom out and put this whole picture together, because it really is a fascinating strategy when you look at it from a high level. We have Ackman trying to build a fortress balance sheet with this modern Berkshire insurance play. That is the safety side.
Right. Permanent capital.
And then inside that fortress, he is holding these massive, high-conviction bets on the utilities of the future, Uber and Amazon. That's the growth side.
It's a classic barbell strategy. Extreme safety on the structural side and extreme conviction on the portfolio side.
And notice what he isn't doing. He isn't trying to pick the winner of the chatbot wars. He isn't betting on which startup will have the best image generator next year. He's betting on the company that runs the servers, Amazon, and the company that runs the physical network of cars, Uber.
That's the ultimate takeaway for anyone listening. It's all about structural advantages. Uber has the network effects in the physical world. Amazon has the network effects in the digital and logistics world. Ackman is betting that these advantages are simply insurmountable at this point.
It really is a lesson in psychology as much as it is in finance. Most of us are told our whole lives to diversify. Don't put all your eggs in one basket. Ackman's doing the exact opposite. He's putting all his eggs in 4 massive baskets and then watching them like a hawk.
It raises a really provocative question, doesn't it?
What's that?
Ackman is basically betting that the era of diversification is over. He's betting that in an AI-driven world, the winners take all. If Uber becomes the transport utility and Amazon becomes the AI utility, why would you ever want to own the second or third best company?
That is a terrifying thought for anyone holding a broad index fund. If the winners take all, you better be holding the winners.
Exactly. And if he pulls this off, if he builds the permanent structure and picks the ultimate winners, he might actually answer the question we started with. He might just become the modern-day Buffett.
Well, we will be watching closely to see if that fortress holds up. Thank you so much for having us break down this massive bet.
Always a pleasure to be here.
And thank you to you, the listener, for tuning in to this deep dive. Next time you open your Uber app, see if a robot picks you up, and think about the billions of dollars riding on that single trip. We'll see you on the next deep dive.